Good morning, everyone. I guess we will get started. People will probably trickle in, but I guess this whole discussion is going to be rather informal. So if people join us, that's okay. My name is Jordan Bernstein. I'm a corporate transactional attorney with law firm Michelman & Robinson. I'm out in LA. We have a national presence. And my practice really is focused on buying and selling restaurant assets, helping independent operators structure their businesses. And I do a lot of business advising relative to the restaurant industry. And I thought today would be interesting for a discussion about independent operators as opposed to this conference has a lot of franchisees, a lot of franchisors, a lot of discussions relative to having a singular brand pushed. A lot of franchisees might have a portfolio of multiple franchise brands or concepts that they have in their portfolio, but they're really their business is dictated by the franchise model, which is obviously has a singular mindset, and it's built upon replicating itself. And I thought it'd be interesting to have a conversation, especially with Bill and Sam, whose businesses go about it a bit differently. And you see a lot more restaurant operators, a lot more restaurant companies doing this across the country, Chicago, New York, obviously the Danny Meyers and Lettuce Entertainers of the world, and Bill and one group. Bill's company is called Sprout Restaurant Group, Sprout LA. I figured we could just have an open discussion, pretty informal. If anybody has any questions throughout, please raise your hand, and each gentleman or myself would be happy to answer. In the room, though, I was wondering how many people own a single brand as opposed to multiple brands or multi-unit operations?
So one single operator?
Just a single brand.
Single brand.
Single brand.
Multi-unit though. Cool.
And anybody have multiple brands that they're working with? Okay, a couple people who
How many people
barely raise their
hit
hand.
a wall because it's the third day in Vegas?
Yeah, thank you for making it out at about 9, 10 in the morning. It was a struggle getting Sam up, but he's here. I appreciate that. So Sam is the CFO of the One Group. I joined the One Group back in 2011. Before that, he was part of the Smith & Wollensky Group. And the One Group, though, has multiple brands, including its primary brand, which is STK. The STK has locations around the country, some internationally in Milan and London. The One Group also has a couple other brands, which are Bagatelle and Asalina. And they've also branched into the hospitality industry, working with hotels. And they have a growing presence in the hotel business, where they have different concepts or different operations that are filling out their business model. And Bill, on the other hand, is the founder of Sprout Restaurant Group. I'm not sure if you have an official title. Bill's business is out in Los Angeles, primarily. Maybe one day it jumps out of Los Angeles. But Bill is the owner-operator of about 10 of LA's greatest restaurants, including Bestia, Pica, Soto, Republique, Short Order, Petty Cash, Rivera, and about 6 more that are coming online, including Redbird, which is a very ambitious project. All of Bill's projects are now pretty ambitious projects in downtown LA, out by Venice, really spanning the breadth of LA, which is a pretty broad town and pretty segmented, and Bill has managed to place different concepts, different brands in all parts of town, which is a feat in and of itself and interesting. And I thought we could have a discussion relative to that. So initially, Bill, most people, I think, as you call it, your former life, you were a chain operator with Louise's, and you've now taken a pivot, and your business model is, as I explained it, you've decided to do many different concepts, all independent restaurants, partnering with different chefs, which is a primary focus of your business model. So I was curious, what was the impetus behind changing your business mantra in the restaurant industry?
Well, as Jordan was explaining, the business model we have now is sort of the most non-linear business you could possibly imagine. So it's 13 separate entities, which is growing to 21 separate entities by the end of 2015. 10 different concepts growing to 17 different concepts by the end of 2017. We have 2 big joint ventures, one with AEG and Niederlander for the concessions operations of the Greek. We have another one with Compass and Wolfgang Puck for concessions and restaurant operations of the Academy Awards Museum, which would be the Academy Awards. We have all kinds of sort of what I would call sort of sub-projects that go with the restaurants that wouldn't immediately surprise people that we were in, but they're not immediately would be things you'd think that we would be in, like the insurance business, which we're looking seriously going into for our own workman's comp. But primarily what happened in sort of in a nutshell, the recession happened in 2009, and in the process of it, in my former life, the Alex Browns of the world and Montgomery's and Piper were the people that I talked to about raising money, and we were a mezzanine sort of company that was raising subordinated debt and tiers of preferred stock and tranches of equity, and we very much fought to get into the world where we had institutional financing, and when you get there, the only exit, which I think Sam will certainly explain fairly well, is to go public, or to be sold to a public company, because everybody is pursuing public market valuation. And when I sort of, in my second life, which on some level was somewhat serendipitous as to how I sort of started this, I've now sort of come to embrace the concept of Rich Melman and, on some level, Danny Meyer, who obviously is probably going public with a company that's a spin-off of his group of restaurants, obviously.
I think that's
Exactly. It's got to be, everything looks like that's what's happening.
Nothing Danny Myers does is quiet, though.
So the concept basically is, you have this completely asynchronous, non-linear model that basically
I think it was termed the anti-chain chain.
Yeah, the
by somebody.
anti-chain chain. So ultimately it will breed concepts that will basically become standalones that will then replicate. And it may be that they replicate in a very traditional way, it may be that they replicate in the same manner that we are now, which is to go into an area where another city where we could open up a group of restaurants and establish a base basically that gives us enough leverage on operations and gives us enough leverage on services. Because basically the business that I'm in is, yes, I'm partnered with chefs, but we operate what essentially amounts to a very sophisticated service business. So we do all the accounting, we do all the underwriting of the financing, we raise or put in almost all the financing. We buy, in many instances, we're buying real estate. We have some very sophisticated partners. Eli Brode is a partner of mine in a project, and he's a signer on notes, and he's a co-investor with us, very pursue with everything we invest. He's also a developer, because if we didn't have him, we could never build what we're building. It's too many cities, too many governmental agencies involved with us, so he navigates that. But we partner with people constantly. And I mean, actually, the key word of our whole business model is collaboration. And the financing of this, which is obviously why we're here, and it's a conference about finance. It is every form you can imagine. If we buy real estate, in many instances, it's far better for us from a leverage standpoint to build out the restaurant than it is if we lease the real estate. So we try to buy. If we can ground lease the property, whether it has a financeable ground lease, we're better off doing that than leasing the property. But if we do lease the property, and in today's world, believe it or not, I look at leases at 20 years and just view them as being way too short. We push very hard to get to 30 years. Obviously, to go over 35 years, you're now falling into, a territory that starts to look and smell a lot like a ground lease. But finance basically is, everything you can imagine other than going public. So obviously, we love the idea of getting public market valuation someday. If somebody wants to give us, 15 times cash flow, they'll be my best friend. But obviously, that's not going to happen, immediately. However, if you really look at the nature of, for example, what Patina Group has done, and Patina is a good example because Joe Keem has probably made more money selling and buying back his company and selling it again than anybody in the restaurant business. He's just sold it again to Delaware North, at 10 or 11 times cash flow. And underlying all that is he's got a very, very valuable private events, catering, events, facility management business, which is really the business that a public company would want to buy. So that's the valuation metric. They'll take the restaurants with it, I suspect, and they're giving them some money for it. But inherently, that is essentially what's happening with us. It may be that we effectively become a REIT. I mean, not that we want to be a REIT, or we are, but we are acquiring a lot of property. So and some of this is just we happen to be in areas where we're pioneering the areas. We might as well buy the real estate if we can or control it, but we're not opening up, thank God, on Beverly Drive and Wilshire anymore. We switched away from the model of chasing the Grove locations, and we started chasing places where millennials wanted to live, and that was anywhere but near the Grove. So the concept of what we're doing has some very interesting sort of tie-ins to what I would call the demographic shift, the shift in retail, the shift in reurbanization, the shift in adaptive reuse. We have a lot of adaptive reuse buildings that we're in that are from 1920 and 1930 and 1940. Obviously, it makes the build-outs and all the work with them a little more complicated, but you extract a tremendous amount of value in doing this. And there's no question in my mind that what Sam is headed into at the one group, which he'll talk to you about, it's no doubt it's a wonderful way to create great wealth. But it comes with it, a very, sort of rigid, linear, short-term, world.
So, go ahead.
So anyway, that's a good segue to
yeah. So the one group has taken their company public, does have public finance behind it, and as I mentioned, they do have various partners, various different concepts that are under their umbrella still. But I think in underwriting the company and a lot of the finance people that they were speaking to wanted to sort of have the one group go a little bit away from the way Bill's business right now is going. Not to say that that's a bad thing, but they wanted to see a more linear approach. And maybe Sam, you could speak to that and as to why, when you had so many different concepts, and you still do, you are really pushing STK. And STK Rebel, which is a secondary version at a different price point of STK.
No, definitely. And good morning, everyone. Sam Goldfinger, recovering multi-brand operator. We had an interesting evolution in terms of why we're public today. It actually started at a different conference. We were at the ICR conference a couple of years ago. I was there with the CEO and founder of the company, Jonathan Siegel. We had, I think, 16 meetings in a row, and we met with a lot of the investment bankers, many of them, some of them here, many of them I've known for years since my days at Smith & Wollensky. And to a T, everybody said, what is it you want to accomplish here? And we said, we're not sure. We may want to be private, we may want to be public. And they said, okay, if you're going down the public route, first thing we want you to do is get rid of all your brands. Stick with your lead horse, and it's going to be a much better approach. And we, for years, were similar to what Bill was saying before. We thought, here we are, we're private, we like all these different brands. When we started going into the hospitality in terms of hotels, we were thinking, okay, we'll have a portfolio, a menu of different brands. So if a hotel needed an Asian concept, if they needed a French concept, or just a steak concept, we had all these different brands, and it just enhanced what we could offer. And we always thought that's a great model. You mentioned Danny Meyer, Steve Hansen, be our guest. Also another great operator, multi-brand. And so it seemed to us that was the way to go. And after talking to a lot of the bankers, they said, or at least most of them said, no, you got a great concept in SDK, that's your lead horse. Take that lead horse. When you go public, if that's the route you choose, and when you talk to the street, you're going to need to be able to make it as clear and as transparent as possible, and it's got to be believable. And to us, we wanted to have a clear message, and certainly SDK, very clear message. SDK Rebel that Jordan mentioned, we haven't opened it yet. It's, I guess, in relation to maybe like a Del Frisco's grill for people in terms of what it is. It's a more accessible price point concept, but it's not any different than SDK. We just went in and said, we're gonna go into multi-cities, call it maybe second-tier cities perhaps. It's a great vehicle to go in there, lower price point. And so we focused, we I guess chiseled a few things off of our tree and came up with a very clear message. We've been public now for a year. This is my second go around being a public company CFO. I'm fine. My handshaking is down to about low roar these days. And
so they wanted you to become more focused and more lineal. I presume for many reasons, obviously, but to create value. And I presume there's a lot of operational difficulties they create potentially that they can't leverage value potentially as much. As when you have multiple different operations going on, and it creates complications. And from a public perspective, you want to have it be a little bit more transparent, a little bit more lineal. So
right. What you don't want is, at the end of the day, if you're going to go into the public arena, you got to play by the rules. And again, it's interesting, and it's always the struggle, right? We're in an industry where it's about creativity and entrepreneurship, and there's an edge to it. But if you can go to the public market, you have to come with a product that makes sense, that people can get their arms around. Because what's going to happen is they're going to try to model your business. And if they can't model your business, they're not going to bother with it, right? And it's a much different proposition than if you go private equity or even just friends and family. In those arenas, you'll get obviously better multiples. And you also, for them, sometimes they'll just put up money because they like you, they like who you are, and they say, okay, this could be something that's fun, and I can walk in and be an investor of a cool place. When you're in the public market, it doesn't work that way. You are viewed as a real business, and no offense, it's not a personal ability, I know you're a real business, but it's looked at differently. They want to understand that it's a business, and they get that it's driven by energy and a passion and a great product, but at the end of the day, it has to be a business that they can understand, that they can model out.
So let me translate for Sam what he just said, so you can because I can give this to you a lot simpler. The private equity markets are run by people that basically are not smart, they're not dumb, they're simple. They view the world very simply. If you stand and listen to Jack Ma, who is obviously an incredibly bright guy, all that anybody can talk about is the valuation. The concept is, my God, this valuation is really high. So obviously, what's going on inside of this model is somebody has put money into this thing and is trying to figure out if this multiple makes any sense. And they're trying to figure it out in the next quarter or the next 2 quarters. And if that's the way you think, that's incredibly simple. Because this is a guy who's got a product inside of his company that's probably worth more than the whole company when they spin it off, for sure. And he already admits that Alipay will probably be more valuable than Alibaba. So, but you're not going to have that happen in 1 or 2 quarters. And here's a guy who far and away is probably the most highly inspected business, and yet everybody is still talking about why in the world is this thing so valuable and how is it going to justify itself in 1 quarter or 2 quarters. So if you look at the world that I live in now, which is actually an incredibly sophisticated world, in some sense far more sophisticated than the world that Sam is going into, you're dealing ultimately with people that are managing money. So what they want to know, and by the way, what we invest at is not to basically look at something that has a growth of 500% over 3 years. It's something that looks at it has 100% return on invested capital over 2 years. That's the metric we're using. And so,
or 1 year in the case of Bestia, which was a nice success.
So obviously that world involves very, very careful use of leverage, the ability basically to spread risk, the ability to have diversified ways to make money, so that we have real estate and we have restaurant revenue, but we also there's an incubator of apps. There's a lot of things that are going on that we're using capital for. And people that are investing, presumably, are investing in some and all of these things, and maybe going forward we'll have a fund where they literally will be just investing in all of them. Where they're not necessarily saying, I'm just an investor in Vestia, I'm just an investor in Republic. And by the way, I'm making 100% return on my money now every year for forever. Who knows how long this will be? It's a huge number. But the concept now is that you're dealing with people that have capital, and now the question is, how much capital could we put to use effectively so that it'll generate these kinds of returns and attract ultimately, more sophisticated investors, or frankly investors that use our products. We love the guy who says, I'm an investor at Republic, and by the way, I've spent $30,000 in the restaurant because if I'm going to go eat anywhere, I'm going to eat in the restaurant I'm invested in. And they're all local. So, we happen to be very big believers in localism, both in terms of buying, but also in terms of our investors. So, I don't think there's anything wrong with the public market, but I think it's the public market is a graveyard. And then,
So aggressive.
the public market's a
As the
graveyard
market
for
ticks up today.
for small restaurant companies. There's a very famous quote that was made to me by a guy who's seen more public companies come and go in his life. Unbelievable, businessman that was on the board of a big company that invested in us. And he used to say, he goes, you guys build some really beautiful boats. And he goes, the problem is that you find the beautiful small boats. And he goes, what we always want to know is, do these things float? Because half the time you put them on the water, he goes, they sink. And he goes, so you got a nice small boat, he goes, but, I don't know, these things sink a lot. And, he was absolutely right. And that's, when I was in the 90s, for every cheesecake factory that came out of the gates, which by the way was panned across the board by everybody saying, how's this guy gonna open up, 50 restaurants when he's got 7? And he basically doesn't seem to know anything about operations. He's just this guy who's got this crazy concept out of California, and nobody could figure it out. And there was Starbucks, and he walked out of the gate at a $700 million valuation, and everybody said, "Oh, this is 50 times earnings, 70 times earnings. Who is this guy? He's a salesman. Nobody's going to buy $30 coffee." But for every one of those, there were 10 others. I mean, does anybody remember Pollo Tropical? They weren't public. There was a whole slew of them. Larry Mandel was trying to go public forever with El Frenaya, and finally did it, then went private, because he found out that public market was a very unforgiving place.
So, Bill, you're
My new PR agent.
so Bill, Barbara.
I'm from Los Angeles. You have all these wonderful concepts. Are you going to cookie cutter them to other cities? Is my first question. And also, are you going to license, or are you going to have? Do you think yourself as licensing, or just opening other restaurants in other cities?
We view ourselves partnering in every instance, but I'll tell you, we'll have, most likely there'll be 30 or 40 in LA. We'll be in the insurance business, we'll own a lot of real estate, we think one of the best financial services management businesses, in the industry, manage it. We'll be partnered with at least 20 or 25 different chefs. We'll be building their brands together with our brands in instances where it makes sense, where it doesn't. They'll go into other restaurants that are adjacent to them. We're in the bakery business. And at some point, and obviously we like the idea of being in the facilities management business. We don't have to invest any money. Compass is putting up the money. AEG is putting up the money. Their capital is a lot cheaper than any capital I could ever get. I mean, Compass sat down the other day and said, we really like to figure out how to make sure that we get an 8% return. I said, oh, fantastic. You guys are my guys.
Entities own their IP, or
Our principal entity owns all the IP in the entities, but chefs share in the IP. They own
So,
all the IP.
in managing the IP, because you have so much going
But I
on.
have negotiations with Jordan about it. Jordan represents some of our chefs. That's how we met.
They were easy negotiations. But in managing that IP and in building brands, and I'm going to follow this up with Sam, but what are some of the challenges you find in today's sort of social media market, and everything is driven by the Yelps and the eaters, and you're pushing so much different IP or different brands at so many times. I mean, your PR agent must be difficult.
We have our own internal marketing team. We have 2 separate PR firms that have no clients other than us. We own social media because our products work really well with social media. my 22-year-old daughter, who now, unfortunately left our company to go work in New York for Purple PR, as the senior social media strategist, mind you, at 22 years old. So she's managing Beyonce's social media and people like that. She totally gets it, and she understands how the story is sold through social media. And we don't, I haven't bought an ad in years. We went to go create an ad actually a couple of years ago. I didn't even know, we don't even have anybody that creates ads anymore. We don't take upfront ads. We would never buy cable. We certainly would buy a radio program. The reviewers and the press, obviously do all the publicity for us, and Yelp is absolutely one of the most influential things. As much as the chefs here to hate me say this, it's incredibly important. The world has now got a consumer that doesn't basically easily translate into something you can advertise to anymore. You can't easily advertise to my 22-year-old daughter. She's a very tricky customer. If the ad looks like an ad, she just turns it off. She doesn't want to look at ads. So you've got to basically get her in a much more organic way. And some of it is what her friends think and what other cohorts think, which part of that is, are they going there? Where's the place located? What's the vibe? And obviously all that translates into an image in social media. And I think that businesses that like Sam's, I think it's important that they understand how to do that. There's no doubt that I'm sure they do it. SDK is a pretty cool place. But we happen to have a model that fits really well into this whole niche, and consequently our marketing expenses are nothing. I mean, we spend less than 1% on marketing, and a lot of that is open table. I mean, we think we're the forerunners of centrally segmented, restaurant seat purchasing, which it's a big debate, but on the board of advisors.
Can you explain a little bit more what segmented?
I'm on the board of advisors of a group called Reserve, which is a startup with the founder of Uber and Google Ventures, and they basically have a completely curated sort of membership group that they essentially send an email in. They say we want a reservation at 8 o'clock. This person is, the chief financial officer of American Express. He drinks Pinot Noir. We know you don't have reservations, so we're going to offer you 140% of whatever he spends. And he's already got an account. He comes, he eats. When he gets done, he stands up, he walks out. The tip's already taken care of. He rates us. We rate him, and we know we have a complete connection to him. A one-click response to anything he does. We know who he is. If something goes wrong, I mean, we know he's coming in. I mean, he's on a list, and he's in our daily makeup, the whole pre-shift where we're going through everybody who's coming in the restaurant. We would like to make sure that pre-shift consists of, at some point, 80% of the people on that pre-shift in any one of our restaurants has notes and has a history that we know, so we can target our care for them in the restaurant. So there's a whole customer relationship component of this that is infinitely more sophisticated than it used to be. And Open Table is a big component of this, because Open Table has, they're the gatekeeper of our reservation book. So those notes that are in Open Table become really critical. And Open Table is, a huge company, and $2.6 billion buyout, by arguably some of the smartest guys in the industry, that paid that to buy them. So there's a whole world going on there that is very meaningful to the restaurant industry and to the marketing of the restaurant industry. It's just the old world of, and I'm not saying this in a deprecating way, but I listen to some, Yahoo that's basically, it's some fund that's telling me about the next Applebee's, and how this is, what he's focused on, and then he jumps inside of, Sam's numbers and starts babbling about some number on the third page that's trending down, and it's a, negative metric, and, God forbid I ever have to do that again. I'd rather be able to sit with a guy and say, look, you made 40% on your money, we raised a fund with $30 million, that people are begging to get into it, and they're not so focused on the loser, they're focused on the winners. And yeah, there's going to be losers, but that's the value of me. I mean, presumably I'm going to pivot and get rid of the loser or do something with it, but the idea is to have them look at the totality of what we're doing in a package and not be so focused on the one thing that they grasp that's some like I said, some metric that basically it's a comp store sale number that frankly comp store sales are important, but it's like you live in a world where that is the only thing that's important. And when you're Chipotle and you're comping 20, everybody thinks you're walk on water. But the math of the world is you can't comp 20 forever. It's impossible. It's mathematically impossible. So I love when everybody sits and says, "Is Apple going to be the next $1 trillion company?" It's like the answer is the law of large numbers. It's like there's a good possibility this could be an incredibly successful company. It'll never get to $1 trillion. Because it's $1 trillion is a lot of dollars. And so it's like when you grow a little company to become, a much bigger company, it's hard to become from a much bigger company to an infinitely gigantic company. And so, obviously I'm in some sense, I'm out of that world. I don't have to basically tell somebody there's going to be 37 petty caches in 3 years. And, and that's a good thing.
So in picking winners and losers or sort of weeding out, obviously a big consideration is where, obviously real estate. And Sam, you're at Bill's business is largely in LA right now. It might be going outside of LA soon, but Sam, you guys have multiple restaurants in actually multiple continents now. And can you explain a little bit, how is it that you go about choosing which cities you want to be in? Because, from a franchise model, obviously you're signing up for rights in a certain area. You guys have the freedom to really pick and choose the best markets, the best real estate, wherever you want to be and however you want to do it, to some degree. I mean, obviously you have some people looking over your shoulder now, but can you explain a little bit how One Group is going about choosing its growth?
Sure. So we've been fortunate. I think we certainly hit some of the major markets here in the United States. We opened in London, done very well. We're opening in Milan later next year. So for us, when we look at certain properties, we certainly take several things into consideration. In terms of the STK brand, or you call it the big box, we think we probably have maybe 12 to 14 SDKs that we can build here in the United States. It's a 10,000 square foot box. There are only so many cities that can really handle a 10,000 square foot steakhouse, and so which is why we created SDK Rebel. Rebel is 5,000 to 6,000 square feet. You can go into most of the major cities in most of the states here in the United States, and I think that's a good 1-2 punch. We could probably do anywhere in excess of 100 to 150 SDK Rebels around the country. And we've been also very fortunate that we're at a point now, and part of it, frankly, is because we went public. And this question came up, but why did you go public? And after this morning, I'm not sure what I'm going to do, though, but we may have to talk later now. One of the things that was interesting about going public, and certainly it was one of the things that we didn't really think about, but have I guess benefited from, is there's a certain transparency about being a public company. And before, maybe when someone asks, "Oh, who are you?" and you say the One Group, and then they want to understand your financials, it's out there now. And there's a legitimacy, frankly, of being a public company. A lot of the big hotel groups that we're talking to now are coming to us, and they know us now, and they know us better than before because we're a public company, and we're very transparent, and they see a value there. And so before, when we were trying to hunt down maybe some of these meetings, they're calling us now from a hotel perspective, and the type of management agreements we get to set up are obviously very good and beneficial. But from a real estate, when we look at leasing, one of the things we certainly look at, and one of the things we've benefited from, is tenant allowance. We certainly look at where situations where we can get strong tenant allowance from the landlord, but it's got to be, it's got to make sense. We also don't have high marketing. We probably are also about under 1%. And one of the things that drives our concepts is not necessarily that we have a celebrity chef, but that we have celebrities that come to the restaurant. And instead of saying that certain celebrity chef is the cook, we do get a lot of celebrities that come, athletes, celebrities, and they drive a lot of the press. Page 6 of the Post in New York, a lot of the press and a lot of the social media, you'll see that this person was at SDK last night. And you're right, your daughter, or my daughter's only 10, so hopefully she's not really looking into that, but that's what they notice, right? They notice this when they see a celebrity at a restaurant. We've got exposure in movies and TV shows that get filmed at our restaurants. So there's certainly, that's all that, as well as being public, is, I guess, giving us an interesting new proposition that people are coming to us, whereas maybe 2 years ago we were trying to find them. And so we certainly have our fair share of opportunities, and definitely no void or lack of opportunities in terms of property. And we're still a young company, and we have a lot of growth potential, and there's a lot of markets that we can hit. So we'll see what happens. But
So Bill, I know a lot of people are approaching you as well, outside of LA and inside of LA. But unlike SCK, you seem to come up with something new and greater every time. You partner with a lot of culinary creatives, a lot of chefs. But can you talk a little bit about the process of? I mean, just to explain, Bill is opening a barbecue restaurant, or it's open as of last week. He has a great Italian restaurant, French restaurant, sort of a Mexican. Pedicast is a great gourmet taco restaurant. Soto's a burger joint. I'm sure I'm missing something. He's got some Latin restaurants downtown. Can you explain what goes on in your mind when you're selecting the next thing? I mean, there's a void, I'm sure, and you just want to fill it. But how do you go about that?
Well,
I mean, is it totally driven by the chef, or?
No, it's it's a triaging of several factors. One of which is the area that we want to go into. So it's we're not necessarily going.
When you say area, you mean the
yeah,
real estate?
Like if Rick Caruso, who we've had many conversations with in the past few months about doing something in one of his centers, says, I want you to do a restaurant here. Obviously, we're going to have to understand what would work there, why would we be there, why would we be there at all. And it's not that it's not a good location. The idea is that it's not it wouldn't be a place that Besti would ever go, nor would Besti be the right thing for that location. So
what kind of diligence? What are you looking at in terms of the study, or how are you making that evaluation?
The first part of it is there's this is a financial conference, so there's a million financial metrics. I mean, we want to be able to run a 5% occupancy cost. We want to be able to run a total capitalization of rent and cash invested, capitalizing the rent at 2 to 1. We want to be able to generate a 50% cash on cash return annually on our cash. We don't want to have more than 30% debt in the part that is the operating capital that's necessary to build a restaurant. We want to be able to do at least $1 million in unit level EBITDA. So obviously that size becomes the issue. We want the lease to be at least 25 years. We'd like to be longer. So there's obviously a lot of factors that obviously affect that. So that's the financial side of it. The other part of it is if it's a location that basically is going to be in a highly commercial area, let's say the Grove, it's obviously going to have to be something that caters to the Grove clientele, but it has to have some identity with our brand, which has to be some type of uniqueness that you won't get anywhere else. It has to be able to be reviewed. It has to be able to have Jonathan Gold go to it and say, this is one of the 99 essential restaurants, and it just happens to be at the Grove. It's got to have a chef partner. That chef partner is going to have to work in the business. He's going to have to earn equity in the business. He's going to have to get at least, hopefully 100%, more than 100% of the base compensation in the form of whatever equity gets. His salary is going to be half of what it probably was before.
We've talked about that, yeah. But
it's a tough one, I know. But so there's a lot of you're triangulating a lot of things, and some of this is it was a little bit of an art form, but a lot of it is sort of logical, and it disqualifies lots and lots of deals very quickly. When somebody sits down and says, well, rent's going to be 8%, and when you go over $7 million, we want 12%. It's okay, you got the wrong guy. We're not the right tenant for you, or we're not the right partner with you. It's more likely what we would say. So I think that the word collaboration is a good example. We want to be very efficient capital users. What people don't look at in the public market as much, at least they didn't when I was always around it. Brinker would walk out and basically take down a ground lease in the 90s for $150,000. Then they'd build a $4 million macaroni grill, and the thing would basically do $4.5 million in sales. And they would capitalize everything and basically, show this thing as basically being, a mortgage with some interest expense and no rent, and serve food that you wouldn't serve to your dog, and run a 20% food cost or whatever wacky food costs they had. And that was a great public company. It's like, we're gonna build these macaroni grills, this is great. Well, where's the macaroni grill today? You know, and quite frankly, where's the Olive Garden today? You know, it's like, I sat down with those people at one point, we were talking about them about buying Louise's, and then they walked on water. It's like, they had the Olive Garden, they had Red Lobster, these things are gonna go forever. And, you know, they just don't. You know, because there's, you know, to me, that model is, you know, first thing is it's a failed model now because the world's not living in these suburban areas anymore. They're living in urban areas. The 22-year-old girl won't go in the Olive Garden. She doesn't want to go there. So you can give all the free breadsticks away that you want. I mean, your market is shrinking. Unless you give away free food for 7 weeks for, you know, $100, whatever it was. It's like, that to me is comical. You know, it's like, you gotta be kidding me. So I think that, you know, the concept, and I'm not saying that the public market is not a good place for restaurants. I think it is for certain restaurants. And by the way, it could be great for Sam. I mean, they make a lot of money.
It's even better.
Yeah, but I think that it's just, you know, it's not a place for small, you know, restaurant companies that don't have incredibly sort of linear paths. Because, you know, the problem is you just don't have enough time and attention that anybody is spending on anything. Like, if they got $1 million to invest, you know, why are they investing in the one group? It's not that the one group's not worthy of it, but it's relative to everything else. So, you know, that's part of the challenge. You have to look at everything else they could be investing in. And the problem is you have to also outshine them. And so it's, you know, it's a very small market. And, you know, let's be serious. Do you know how much money is out in the world today? It's incredible. I mean, we went to go buy a piece of real estate the other day, and the broker sits down with me and says, well, you know, and by the way, we're the tenant in this place, and we have a very under-market lease. And the landlord is a trust, they want to sell the building. So they basically said, well, we want to sell the building, and we figured you guys are the guys to buy the building. I said, great, fantastic, we have a great business here, we'd like to buy the building. Well, if we get to buy this building, we're going to get to pay on our mortgage 50% more than we're paying on our rent, because the rent's below market. And by the way, the mortgage is derivative of a price that's built on a 4 cap. So basically, this guy, the broker says to me, he goes, well, you know, this type of property we can sell on a 4 cap. I said, who? It's like, why? It's a single-use building. He goes, oh, because they got you and Glick as the guarantors, and it's some doctor who basically has $1 million to invest is going to say this is a great thing for him. He gets a 4% return, and he knows he has somebody that's never going to default. And the property's going to go up, you know, the rent's going to go up a few percent every year, you know, whatever the cost of rent goes up by 3%. It's a fixed rate increase. He loves to steal, because that's the buyer. And so, you know, that's the reality of the world we live in today. I mean, there's so much money out there that, you know, there's 1 million doctors that have millions of dollars in the bank at low interest rates, and they think, well, owning a piece of real estate that has a single-use tenant in it that's triple net is a great way to invest my money. And I started thinking about it, well, that's probably right. That is a good way to invest your money. It's about as safe as you can get, you know. If we didn't have earthquake insurance, it would really be the perfect thing.
Not the whole country has to worry about that.
So, I mean, I think that this is, you know, in a finance conference, the discussion is not, you know, the linear finance world, in my opinion. It's the non-linear finance world. And it's not friends and family. Listen, the days of getting 35 limited partners in a restaurant, because I can't begin to tell you, Sam is in a great world compared to that. I mean, that is a nightmare. You know, it's like you can't imagine, you know, some person who's invested, you know, $30,000 sitting down with you and explaining, you know, why the menu's wrong. By the way, they don't have any vote, they don't have anything, but, you know, they're investors and they come in and eat, so you have to talk to them. So, you know, you get 30 of those and you have 15 restaurants, you have 400 of them, you know, it's you go out of your mind responding to this. I mean, I'm famous for being the world's most unresponsive person.
But I did get him here, which is good.
And I say that not with any great pride, but the problem is that there is a point where I tell them, listen, we can give you financial information, you know, sort of quarterly, you'll get your returns annually, but we're really not set up to have sort of long discussions, and these are people, my friends, so I'm not set up to have a long discussion with you every month about how the restaurant's doing. Like calling you up saying how the restaurant's doing, you're gonna get an answer, it's good, bad, you know, up, down. You know, and then a little discussion, but it's like when you get to the point where how could I possibly have that discussion with 450 people? Well, let me tell you something. That's what
Transparency.
He's going to get 450 people, because they're all going to be analysts, and they're all going to be at every private conference he goes to, And they're basically all gonna be smart guys that look at tons of numbers, digging into these numbers, looking at the trends inside these numbers, looking at, analyzing the plan. And it just, it's just, the money is actually very expensive. It's much more expensive than you realize. So the upshot of this is, we're very happy being a private company. I'd love to get a public market valuation. We obviously are gonna move into bigger pools of money as we go forward, because even the people that I've invested with and people invest with me, although they have lots of money, they're not that interested in writing $50 million checks, but they're gonna write $5 million checks. But as you get into the next pool of money, there's a lot of money out there, and there's a lot of people that want to invest money with people that are successful at doing what they're doing, and that have some track record of consistency and being able to produce good returns. And so, the end game, everybody asks me, well, what's the end game? How do you get out? What's the end?
That's one of my questions for you, actually.
The answer is, I don't know. Not worried about it. We're making lots of money, and we'll continue making lots of money. We'll continue growing, and my son started a little company. I invested in it. 25 years old. Sold it to Open Table, 6 months ago for $20 million. I'm not supposed to say that. He's 25 years old, and he created an app that did nothing but burn money. Never made a nickel. By the way, it could have in the future. That's why I bought it. But it's a great product. But that's the type of thing that inside of our business, there's a million of those things that are embedded in our business. That if you figure them out, they're not necessarily restaurant products, but they're restaurant products. And so it is. It's not linear, and it would frustrate the hell out of the people that he's talking to have them talk to me, because they would say, well, we don't get it. We don't get it. I don't understand. How are you going to grow, big? How are you going to grow fast? This is too complicated. Way too complicated. Oh my God, their head would fall off. Yeah. But listen, Steve Cohen's business is pretty complicated, and he's made a lot of money. And so has a lot of people. The bond traders are pretty smart guys. They figured out this whole idea that you change the price by 10%, they'll turn from being a buyer to a seller. That's sort of the logical way to really look at this. And I think that's the world that really exists in finance. Right? There's a lot more money doing that than is necessarily standing around trying to chase the next $50 million company that's going to become a $250 million company or $500 million company.
Well, I think we're running up against the clock. I think we have time for one or two questions. But I did want to thank Bill and Sam for sort of sharing their thoughts. I think this was probably the most non-linear discussion we've had. If anybody does have a question, I think we have time for one or two. If not, I'm sure. Okay. I don't know if anybody has a question, but okay, sure.
The entities all have a shop partner. Sometimes they also have a general manager partner, but there's basically an umbrella entity over the top of it, majority owner spread, that really provides nothing but services.
And capital.
And capital. And cheerleading.
Lots of that. Emotional support as well. All right, I think they're kicking us out, but I want to thank everybody for joining us. I hope you found it